Just going to give you a bit of a quick heads up for all of you who are watching the markets, whether you're looking at crypto or traditional markets today, whether you're looking at thinking of trading Bitcoin or Solana or Ethereum or Litecoin or BNB or DOT or XRP or Fetch, you name it, whatever you're into. There's millions of crypto tokens and there's millions of traditional assets around the world, many thousands of them, including derivatives and stonks and commodities and forex, just in the U.S. markets alone. So, what are those assets likely to do today? Well, how can I go through an entire market in a short video? Well, the answer is that those assets are going to do what they always do. They're going to do what the VEPS indicates the vast majority of the time. And specifically, they're going to follow the returns. In terms of price action, that's what's going to happen. It's going to follow the returns. How do I know that? Well, statistically, we can prove that. We just look at our charts, we look at the indicators of the returns oscillator or the alpha laser returns, and we can see what the returns are doing. Right? It's literally telling you up, down, positively correlated, negatively correlated. Same thing with the volatility, which is the standard deviation of returns, whether it's going up or down, and whether it's positively correlated or negatively correlated. So we can see quite literally if the returns are moving up or down, if they're positively or negatively correlated. And that can tell us very clearly what the price action is likely to do. Now, how do we know that? We know that because we can see it candle by candle happening. We can do that on any asset, on any time frame. It doesn't matter if it's crypto or a traditional asset. It doesn't matter if it's a derivative or an underlying asset, right? It doesn't matter because we are able to demonstrate with great clarity exactly what those assets are likely to do and be right the vast overwhelming majority of the time. It's not that we're right because we're guessing with a crystal ball. It's that the indicators are right because the indicators are showing you what the actually relevant maths are, as I've said in countless videos at this point, which I will keep saying in more videos. Right? If you're new to trading, or if you've been trading a long time and you've been using traditional technical analysis, you'll know that traditional technical analysis has no calculable edge, right? And you'll always hear people in the traditional TA world tell you about their edge. Their edge. What is their edge? They literally cannot quantifiably show you an edge. They can tell you they have an edge. That does not mean they actually have one. They can tell you, oh yeah, my edge is this strategy plus that strategy, Fibonacci's plus EMAs plus order boxes plus channels, and then I divide by one using the RSI. It's all silly nonsense. They can't actually tell you what the probabilities are of price action ending within a certain area or another area or another area. They can't tell you the probabilities. They have nothing to do that with. And they can't tell you whether it's going to happen on this candle or the next candle. And they can't tell you what's likely to happen on this candle or the next candle because they don't have an edge, right? Because they're just using Voodoo TA. And I call it Voodoo TA because that's really what it is. It's a bunch of voodoo, right? It's a bunch of hokey pokey stuff. Just, hey, throw a dart at a board and see if you're right would actually give you a better percentage probability because either you hit it or you don't. 50-50, right? Flipping a coin, same thing, 50-50. And actually coin flips are better than Voodoo TA because we actually have a great coin flip indicator at Alpha Trading that works really well. And you can tell me, yeah, but coin flips are always 50-50. Yes, each coin flip is 50-50, but stacked one after another, the probabilities don't always, it is demonstrably not just 50-50, right? And so we can show, even using coin flips, probabilities better than Voodoo TA, We don't use our coin flip indicator that much. We have it; it's great. Sometimes it's fun to use. Sometimes it's a fantastic indicator, but it is even more accurate to just use normal distributions and Laplace distributions for trading. Why? Because the big bots that run the markets use those same distribution models. And when I say they run the markets, again, I mean they run most of the trades on the markets. And by most of the trades, I don't mean 51%. I mean, they run the vast, overwhelming majority of all trades on the markets, right? We're talking usually around 80% of all trades on all markets on all time frames on any asset class and on any assets, right? It's statistically, it's impossible for retail traders to run more than that, even though there are millions of times more retail traders than there are HFT bots. The HFT bots run millions of trades per second, each one, right? So if you have even just a dozen HFT firms running super powerful bots at millions of trades per second per bot, and they've got a whole bunch of bots in each of those firms, and they've invested a lot of money into having a lot of people managing those bots and monitoring them 24/7 around the world, right? They don't just have the traders using them, the managers use them, the technical people monitoring them, the engineers are monitoring them, the support people are monitoring. There's a lot of infrastructure that goes into running or building and maintaining and running these huge algorithms. It's a significant operation, right? That's why they've invested. I mean, the cost of running these things is not cheap. They invest a lot of money into them, but they reap significant returns from them every quarter and every year. That's why they keep using them, right? They don't just use them because they're fun. It's fun to use bots. Oh, I can automate my trading. No, they don't just use them to automate their trading. They use them to run massive amounts of little trades every second. When I say little, I mean probably bigger than most retail traders will ever run, but they're little relative to the size of the HFT firm and the individual trader's portfolio that they manage. So if they give a junior manager $100 million to move, to move a bunch of coins, move a bunch of assets, whatever sector of the market he's attached to or she's attached to, they've got $100 million to play with. How many retail investors do you know that do that, right? Even if they give them only $10 or $20 million to start with, which is they don't. They give them a lot more. But let's say they give them $10 or $20 million to play with, to start with, to trade. They're not just investing it all on one coin and waiting for that coin to move 15, 20 minutes of time and then take the trade. No, they're putting an amount on tons of, the entire crypto market, the top 1,000 coins or whatever, the top 100 coins, whatever they're trading, right? And their robots place orders for those 100 coins in tiny positions relative to the amount that they have, a few thousand here, a few thousand there, 10,000, 20,000, 100,000. And they run those orders and they take profit pretty much as soon as they run the order. Like 0.2 seconds is the average length of time for a trade to last for an HFT firm. And they stack millions of orders per second. That's how many they run. So if you're running millions of trades per second across, your bot, and there's like maybe 10, 20 managers, using the bot, or traders using the bot, and they stack millions of trades per second across those bots, they're not running those trades manually every 0.2 seconds. No, they set parameters for the bots to follow using the leading information of the returns, of the entropy, of the volatility, of the probabilities, of the statistics. They use all the same VEPS leading information that we use in alpha trading. Their bots follow those rules, and because they have incredibly powerful bots with incredibly fast connections to the markets and incredibly significant position sizes compared to the retail traders, their orders get processed first. They're at the front of the line, always, for buying and for selling, because their position sizes are bigger than any retail trader for the most part, right? Sure, occasionally there'll be a massive whale who will come in and put a $500 million order, and he'll get to the front of the line, but the HFT firms will snatch that right up and get right back in front of the line as soon as that order is processed. It doesn't take a long time. But that's how and why these HFT firms are able to literally run the vast majority of the markets. So when you're wondering what is the invisible hand that everybody always talks about, if you've ever heard of the invisible hand that controls the market, right? The all-knowing invisible hand. What is that invisible hand? It's not some magical thing. It's literally the orders running the markets, and who runs those orders? The HFT firms, right? And the quant shops that build algorithms for HFT firms. Many of them also run their own trades. There are shops like D.E. Shaw and many others. Why do they do that? Because they know they can get significant returns running a multitude of very fast orders, even if they lose a few here and there. They lose a very, very, very small percentage of their trades. They're in the business of making money. They're not in the business of losing it. Right? They're in the business of stacking gains. At the end of the day, they stack gains, and they don't sleep on their trades. Right? Yes, a trader goes home at the end of the working day, but the managers are always available and the traders are always available in case something crazy happens while the bots are running 24/7. And there are supervisors and operational managers and engineers and technical support people observing and monitoring the robots to make sure nothing crazy is happening 24/7. And they got people staffing it literally around the world. And why wouldn't you? These markets, the crypto markets, 24/7. And guess what? Traditional markets, a lot of assets trade 24/7 also with after hours trading. And some of them run only 16 hours. Some of them run 20 hours. Some of them 24 hours. The point is, there are markets and trades that can be done by bots 24/7. Because if America's sleeping, Australia is open, Japan is open. Once Europe is, Japan starts to close, Europe is opening. And then, shortly after that, the U.S. is opening some hours later. There's always trades running on markets 24 hours a day, 7 days a week. There isn't a day, even a national holiday in your country, is not going to be shutting down all the markets around the world. Even when a massive, quote unquote, black swan event happens, like happened 4 years ago, and you know what I'm talking about, right? That didn't shut down all the markets. Did it shut down the New York Stock Exchange for a couple days when they didn't let people come onto the floor? Yeah, but people don't really go on the floor there anyway. They traded from home, so it didn't really affect them, right? People were trading from home. They were trading online. They were using their online connections as they always do. Right? They were trading other things those days because those markets were closed for a couple of days. And that didn't cause the entire market to shut down, and markets around the world remained open. Many of them, not all of them, a bunch of them shut down. But guess what? Crypto didn't stop, and it doesn't stop, and it won't stop, right? But generally speaking, crypto assets are running 24/7. Now, there are a couple here and there, extremely rarely, that shut down for a day a week, that are created by, people that have particular religious observations. Or they create them for people who have religious observations. So they don't run them on certain days of the week. Some don't run on Friday, some don't run on Saturday, some don't run on Sunday. But we're talking about a handful out of millions of tokens. The vast overwhelming majority of crypto tokens run 24 hours a day, 7 days a week, every day of the year. Anyway, that is how and why we know that what the markets will do today is follow the VEPs, as they always do. And that means price action will generally follow the returns. Can it be out of step for a candle of two or even three? Yes. But eventually it will fall back in line because other than randomness, right, which is a thing, but other than the randomness, even when it's random, price action generally follows the returns. It's not a debatable point. It's provable, and we show it every day on our live streams at Alpha Trading, which, by the way, start at 9 a.m. Monday through Friday, 9 a.m. Eastern Time. U.S. Eastern Time, just to be clear. Is there another time zone where they say Eastern Time? Anyway, so if you want to join the Alpha Trading live stream, just go to alphatradinghq.com/Discord, and it's free to join, and it's free to get the free volatility starter pack of indicators. It's free to join our live streams. It's free to get all the educational information you want. The whole point of Alpha Trading is to help retail traders learn a better way to trade using the VEPs. Okay, that's it. Happy trading.